Hello and welcome to this video here. My name is David and this is DC Capital. And today I want to share this trade recap on shorting the NASDAQ. This is my biggest trade so far in my trading career. I made over 11K during this short trade in NQ in less than 4 hours trading intraday price action. Also, I will share my TradeStation statement for full transparency. In this video, you will see my exact analysis and thought process behind the trade idea, and I will give you my playbook that I have used for this trade. So I'm sharing a lot of value, and I hope this video is insightful for you. So let's jump right into it. Now let's dive deep into the overview section. First of all, I will start with the most important part, which is the trade recap and the framework behind my trade idea. Then we'll jump right into my personal playbook that I have used for this entire trade, and you can use it as well in your own trading. Additionally, I will tell you why the trade worked and how you can apply this into your own trading. So let's jump right into the daily chart. We are doing a top-down analysis as always for the trade. This is the daily chart for NASDAQ100 December contract. So what we can see here, we can see that price opened, traded up higher, rated the all-time high here on Wednesday. This is Wednesday's candle. And from there, it is aggressively trading lower and closing bearish. So we have an open, high, low, close, classic power of 3 bearish day. Inside a Thursday reversal weekly profile. We can see that Thursday here, this down close candle, is making the high of the week and closed bearish. So we are trading into external range liquidity. We are rating buy side liquidity here, previous day high, and from there price is seeking lower prices and is trading into internal range liquidity. So internal range liquidity is a form of sell side liquidity here, and inefficiency, busy, buy side imbalance, sell side inefficiency. So my internal range liquidity here is the draw on liquidity and my target for this trade. In conclusion, we can see that price really is in a deep premium at the all-time high, and we have a lot of room to the downside for a potential retracement. With that being said, now let's jump right into the hourly chart. We can see again that price rated Wednesday's high here. This is the all-time high for NASDAQ. So from a daily perspective, I'm really interested in shorts for Thursday. This is Thursday's price action. We can see that price is trading lower and created those relative equal lows. This is where my focus is. Price is retracing higher into internal range liquidity, which is this 1 hour SIBI inside the premium. This is where I have built up my initial position with 2 contracts. And as price is trading lower, I'm adding and permitting into my winning trade and take full profit at the external range liquidity. One thing I forgot to mention is that also we have this bearish market structure shift here on that candle, so this confirms the bearish order flow here. Now let's jump into the 15-minute chart for the intraday price action. We can see again the daily context. We have rated Wednesday's high. We are trading into external range liquidity From there, around midnight, we have heavy displacement lower, so a large range, and therefore we can expect London to be in a range, to be a sideways, low probability market condition. This is exactly what we can see here, and we can also see that this 50-minute CB is acting as resistance. Price is not willing to trade above it. This is really bearish and gives me additional confluences for short entries. So London was in consolidation, and we see this displacement lower at the start of the New York session and the bearish market structure shift. We have created those relative equal lows, and price is retracing higher into the premium. This is where I executed my initial position with 2 standard contracts. As price is trading lower, I've entered again inside this 15-minute CB, and I'm trying to make my winning position even bigger, decreasing my open risk. I'm increasing my reward to risk ratio, and this is professional money management and trade management. We can see that New York lunch is retracing higher against those profitable positions and is taking out minor buy-side liquidity and traders that have moved their stop loss too aggressively on the trade. So once the minor buy-side liquidity has been raided here, we can see continuation into the external range liquidity into my target. So this is my trade recap and framework for this particular trade. And the most important thing is really that you have a daily context, a higher time frame context of why price should move a specific way. Then you can go down into those lower time frame charts and find alignment in order flow and set up execution. Also, one important thing to risk management and trade management is that when you are adding to that winning position, make sure that you are trading your risk according to market structure. Because when you are adding to the trade, you don't want to increase your open risk. Your open risk should at least stay the same, and ideally it should be lowered. So that way you are increasing your reward, and your reward to risk ratio will also increase. So we want to really make our winning trades big and keep the losing trades like small. This way our expectancy is going to increase, and this is really important for money management and long-term consistency in trading. So let's jump right into the proof, the live account statement for full transparency. This is my TradeStation statement. We can see here that I have executed 2 contracts short at my initial entry. I have permitted 1 more standard contract into my winning trade, and I have covered 3 contracts at my target. I'm fully out. Additionally, we can see the gross profit of $11,120 US on this single trade, and the net profit for this trade after commissions are deducted. Just for your information, for privacy reasons, I have blurred out some sensitive informations on this statement. Now let's jump right into my personal playbook that I have used for this particular trade. So I have used my Playbook 4, which is my fair value gap continuation model. So the most important thing when it comes to my Playbook 4 and or any other playbook I'm using in my trading is the higher time frame context. The higher time frame context is most important, and we have to keep that in mind. So from a higher time frame perspective, from the daily chart, I think that price will trade lower, and therefore I'm looking for this fair value gap continuation model in a bearish order flow. So the first thing I want to see is that the market is trading higher, taking out buy side liquidity. Once price has been traded into the external range liquidity, I'm looking for displacement lower and a bearish market structure shift. Once those two criteria are met, I'm looking for a drawn liquidity. This could be relative equal lows, this could be a singular low, this could be inefficiency, something to target. So in this example, I really like targeting those relative equal lows because I found out in my backtesting for the playbook that those relative equal lows in the bearish order flow are a really high probability draw on liquidity. So now, once all those three criteria are being met, I'm looking for retracement into a premium. And since this is my fair value gap continuation model, I'm trying to participate on the bearish order flow, the bearish continuation inside a fair value gap that is in a premium. So my short entry is inside this fair value gap here, and I'm targeting my drawn liquidity, in this case those relative equal lows. I'm taking full profit at the external range liquidity. So my entry is inside this fair value gap, SIBI, that is inside the premium of this dealing range. I'm entering inside internal range liquidity, and I'm exiting fully out at external range liquidity. So now I quickly want to go over the why behind the trade idea, because this is really important before I'm entering any trade. I want to make sure that I'm trading in sync with the higher time frame context. I want to have a clear drawn liquidity for price. When I'm entering in internal range liquidity, I'm trying to target external range liquidity. When I'm entering at external range liquidity, I'm trying to target internal range liquidity. Market efficiency paradigm. Remember that price, first of all, needs to trade higher to engage some buy side liquidity, some buy stops before it is allowed to trade lower. So price needs to first trade up to trade down. This is the market efficiency paradigm, and I want to short in a premium once price is trading higher. Time and price alignment is really important because during specific times of the day, there will be high probability setups, and usually you will see those high probability trade setups around 9:30 a.m. New York local time to 10:30 a.m. New York local time. So between this 1 hour time window, you will most likely almost every single day find a high probability setup that is based on an S&P divergence, fair value gap, liquidity, or inefficiency, something to that effect. Then for my risk management strategy, I'm targeting at least 2R. So my risk will be, for example, $1,000 and I'm targeting at least $2,000. This allows me that I have to be correct only on 40% of my trades in total to be net profitable in the long term. Internal range to external range, we already covered that. I'm holding onto my winning trades and pyramiding into it. I'm trying to reduce open risk and trail my stop loss in respect to current market structure. Really important for trade management. So now let's jump into the last slide, and really the most important maybe for you, because now I want to talk about how you can actually apply this to your own trading. So the higher time frame context is key. Perform a top-down analysis and really dive deep into the daily chart. The daily chart is so powerful and really gives you an advantage. Before the trade, determine a clear drawn liquidity. Where is price most likely going to trade to next? Follow your risk management and trade management plan with discipline. This is really important, and it is way more important than the actual setup. Because if you have great risk management and trade management, this will keep you in the game. Emotional awareness. Execute math, not emotions. Just be aware of your emotions like greed, like fear of missing out, impatience, something to that effect. Because sometimes we are trading against our trading plan because of those emotions. With that being said, it is really important that your process is more important than your outcome. And how can we do that? We have to divorce ourselves completely from the money. If you are trading, think in terms of process and not outcome. Stick to your risk management, stick to your trade management, engage your trading plan rules. This is really important when it comes to process, because process is the most important thing in trading. Knowing how to lose and learning how to lose is a key factor in your trading, because as traders we are facing losing trades. We also face big losing streaks for days, for weeks, and therefore make sure that your risk management is in line. Risk management, trade management, knowing how to lose and following that process is such a big topic and such an important topic on trading. Let me know in the comments if you want to have a video only dedicated to those bullet points, because I think that this will really be helpful. So last but not least, if you stick to those key points I've mentioned here, consistency compounds, and this is exactly what we want as traders. We want our equity curve to increase consistently, so make sure that you follow those bullet points before the trade, and remember that consistency and following your process is the most important thing in trading. With that being said, thank you very much for your attention. I hope you found this video insightful, and I'll see you in the next one.